This presentation covers the federal tax law changes for tax year 2021. There are a few caveats. Your local coordinator may deem appropriate to consider some of these changes to be out of scope for your location. The IRS will also issue additional guidance on many of these things. Form instruction revisions are ongoing and will continue to be ongoing probably into 2022. Additional updates will be communicated as we know them. So the changes that we're going to talk about today are numerous, so we're going to spend some time talking about all of these. We're going to talk about the forgiveness of student loans, a discharge of main home debt, higher education grants, recovery rebates, emergency rental assistance, education benefits, business meals, residential energy credits, medical deduction floor, the PMI, the private mortgage insurance, charitable contributions. We're going to talk about the economic impact payment number 3 and the recovery rebate credit that's associated with that. We're going to talk about child tax credits, earned income credits, child and dependent care credits, sick and family leave credits, premium tax credits, and the Form 1099-K reporting that's associated with online sales of various things. The first change that we're going to talk about is the forgiveness of student loan debt between 2021 and 2025. So this is good for 5 years, the next 5 years. I think what you're going to find after reading through this slide is that pretty much most, if not all, student loan debt that is forgiven is going to be excluded from gross income. The bullets in this slide pretty much cover all the bases so that I don't see very many exceptions, if any, of student loan debt that would not be forgiven. So it's student loan debt that's either through an educational institution or through the lender themselves. If made, insured, or guaranteed by the United States or any agency thereof, also can be insured or guaranteed by a state, a territory, District of Columbia, or any political subdivision. And it also can be guaranteed by an eligible institutions as defined by the American Opportunity Credit. So if you look up the American Opportunity Credit, you can see what an eligible educational institution would be. And again, that's most certified institutions. Any private education loan or by an educational organization. So here again, I don't see very many exceptions to this, so I think most student loan debt would be excluded from gross income. Discharge of main home debt for years 2021 to 2025, 5 years. The laws have been changed in 2021 to 2025 to exclude the tax on the discharge of the main home debt. So in situations where somebody may have, the bank may have foreclosed on someone's home, or they simply, the homeowners couldn't afford to pay the mortgage any longer and they simply walked away from it. At some point, they would get a 1099-C from the bank indicating that they had debt that had been discharged, and that usually makes it taxable. So in years past, they were able to exclude up to $2 million, but now that's been changed in 2021 to 2025 to be $750,000 that they can exclude from taxation. It applies to discharges that happened after December 31st, 2020. And as I said, it's effective over that 4 or 5 year period. The problem with us, of course, is that it is out of scope for Massachusetts Tax-Aide. And the reason for that is that it's out of scope for the state tax. The Massachusetts discharge of home debt on the Massachusetts tax return is clearly out of scope, and that therefore makes it out of scope for the federal tax return as well, but only in Massachusetts. If you're a volunteer at other sites other tax aid sites around the country, this would be in scope. So that's it for now. Higher education emergency financial aid grants. So these emergency grants are also excluded from gross income, and they're defined as school grants under the CARES Act for unexpected expenses, such as unmet financial need or expenses related to COVID-19. And they can be things like food, housing, course materials, technology, healthcare, or childcare. And as I said, they're not included in gross income for 2021. And they do not reduce expenses for the American Opportunity Credit or the Lifetime Learning Credit. So the expenses that you would normally use for both of those credits, American Opportunity and Lifetime Learning, do not get excluded by these emergency financial aid grants. Now, we may need to analyze the student's financial statements in order to pull these things out and determine that they're excludable from tax. Emergency rental / housing assistance. So any assistance that is given to the taxpayer to help pay rent, utilities, home energy expenses, and other related expenses would be not taxable in tax year 2021. And that's no matter whether those funds are paid to the taxpayer or paid directly to the billing party. Of course, any income to the billing party is taxable as it usually is, so that doesn't change. So this is strictly for the benefit of the taxpayer, not for the people receiving the money. Home mortgage interest or real estate taxes that are paid through this tax-free assistance are not eligible for deduction on Schedule A. So a taxpayer cannot have it both ways. They cannot get a break on their mortgage interest and real estate tax as far as being given the funds to pay for those expenses, and then also take a deduction on Schedule A. So that would be as analogous to double dipping. Here we have a permanent change to the tax code. I guess the exception I would take with this is that it seems like nothing is really ever permanent with the tax code. So even though they're saying it's permanent, I would not be surprised to have that not be the case. Anyway, education benefits. Tuition and fees deduction, which we've had for a number of years. It's almost fallen off a cliff a number of times, but this time they're saying it's permanently off of a cliff, and it no longer exists. So we used to have this option for tuition and fees, which used to help out for people that had extremely high tuition and had no scholarships or grants. So they ended up having to pay all their tuition out of pocket. So this used to help people like people that went to BU or BC, those kinds of people that paid all of their tuition. But it's gone now. So for 2021 and beyond, it no longer exists. A lifetime learning credit has increased income amounts for 2021, and now they're the same as the American Opportunity Credit. So there is no difference in income levels for the two credits as there was before. Here's a change that's good for the next 2 years. Business meals on Schedule C for 2021 and 2022. The business meal deduction for self-employed people is now up to 100% deductible. It's always in the past been 50%. So it's 100% for the next 2 years. But the meals must be provided by a restaurant. They can be takeout meals, however. So either eat in or take out, and they're covered 100%. But it goes back to 50% in tax year 2023. It remains 50% if not provided by a restaurant. So if somebody walks into a grocery store and buys a prepared meal, for instance, and takes it out to their truck and eats it, that's still a 50% coverage. The National Tax Training Committee, NTTC, self-employed Schedule C worksheet has been updated to reflect this. The residential energy credit for 2021 only. The residential energy credit has been very close to being retired over the last several years, but Congress over the last several years has voted to keep it going yet for another year. So 2021, I guess, is no exception to that. It's extended for 2021, and you can see page EXT6 on your volunteer resource guide, publication 4012, to get more details about that. Generally for windows and doors, windows and doors, generally if they meet version 6 of the Energy Star qualification, they're covered under this tax law. But some of the other things like furnaces and things like that have different rules. So you really need to look at EXT6 of publication 4012 to get the details. We're going to talk a little bit about itemized deductions, but I want to start by saying that there is a Schedule A worksheet that's available on the AARP volunteer portal that is actually quite good. And in the last couple of years, we've used this worksheet. So when people come in with a bag full of receipts and various other things that end up taking us forever to go through, or causing us to turn them away and ask them to go to a paid preparer, we simply hand them a Schedule A worksheet. We find a spot for them to sit down at a table and fill out the worksheet themselves. And it really makes life a whole lot easier for the preparer. So I highly recommend that you have a supply of these Schedule A worksheets available at your site and use them. So let's move on. As far as medical itemized deductions, they are now permanently set at 7.5% of adjusted gross income. There have been several occasions where it has come close to moving from 7.5 to 10%, but that has never actually happened. And based on this permanent change here, apparently it's not going to happen in the future. So 7.5% of AGI is where itemized deductions for medical are going to stay. And private mortgage insurance. So the last several years, this has been included with mortgage interest for people that itemize. But now they're saying this is good only for 2021. And this is another item that has been voted back from year to year, but there has also been plans for this to be dropped. And at some point, it probably will be. But for 2021, it's there, and it's going to be included with interest on your Schedule A. And for 2021, this is a rather important charitable contribution deduction that has been changed from 2020. In 2020, we had as much as $300 worth of charitable contributions that could have been deducted on someone's 1040, even if they didn't itemize their deductions. This year, that's now moved for married couples, it's moved to $600 for the couple. So all the other filers, whether they be single or head of household, still are limited to $300. But for married filing jointly, they can now deduct $600. And it has been moved. It no longer affects adjusted gross income. Last year it did. This year they've moved it to below the line, a term meaning below the line, meaning below the AGI line. And it's now being an adjustment to income that does not affect AGI. And entering deductions in TSO is the way that you go about doing this. So there's no special place to put these deductions because they're not part of itemized deductions any longer. You still go to the itemized deduction worksheet and you plug that information in there. So this is a change in the tax law. Charitable contribution deduction. Most cash contributions are now allowable up to 100% of AGI. So I don't think this is going to affect our taxpayers for the most part. I don't know of many of our taxpayers that actually contribute up to 100% of their AGI or even 60% of their AGI to charities. But it's allowable if somebody wanted to do it. And it does go back to 60% in 2022 to 2025. And then back to 50% in 2026. So, but for now, if somebody wants to contribute 100%, they can do that. The next three slides deal with economic impact payment number 3. Economic impact payment number 3 is actually an advanced payment of the recovery rebate credit for tax year 2021. And the way that the IRS did this is they looked back at tax year 2020, and if there was no information available to them for 2020, they'd go back to 2019 and look at that tax return to determine how many dependents the taxpayer had, that kind of thing, and establish what the taxpayer likely would have in 2021 for dependents, and so that they knew how much to pay out. Now, unfortunately, a lot of the 2020 tax returns, even to this day, have not been processed. So 2019 was more probably the year that was being used to determine what the rebate, what the economic impact payment number 3 is going to be. Now, once the 2020 tax return does get processed, then the IRS is going to make what's called plus-up payments. So if there was a difference between the 2019 and 2020 tax returns, they would pay out the difference. So if there was, for instance, a dependent that existed in 2020 that did not exist in 2019, they'd make an additional payment. Once they learned that information from 2020, they would make that additional payment to the taxpayer. And then if there was no tax returns filed at all for 2019 or 2020, then the IRS said that they were going to base their information on any available data that they have. So I'm not privy to know what those various sources are to determine that information, but they have their ways. The IRS is creating rules to avoid abuses such as double payments. We've had a little bit of a hint as far as what some of those rules might be, but it's really too early to define them as far as for training purposes. So I'm just going to say that there's just more information to come, and we'll learn more in the coming weeks. The IRS will also issue a letter 6475 in January of 2022. So this letter will come out with a lot of the other tax documents in January. And so I'm going to talk a little bit more about this in a future slide, so I'm not going to say much at this point. EIP 3 amounted to $1,400 for an individual and $2,800 for a married couple. Each individual had to have had a Social Security number and must be alive in 2021. So if somebody had passed away sometime in 2020, they would not have qualified for this payment. There is an exception to this rule if either the taxpayer is in the military. So as far as needing a Social Security number, if either taxpayer was in the military and had a Social Security number, it would not have been necessary for the spouse to have had a Social Security number as well. So they would have gotten the payment for both as long as one of them that was in the military had the social. $1,400 also per dependent. So if there was a dependent on the tax return, there's no age limit this time around, and they would have received an additional $1,400 for that dependent. Although the dependent must have had a Social Security number or an ATIN, which is the identification number that's issued to people that are adopted. So that's an adoption tax ID number. Here we have the income phase outs for the EIP3, and it begins to phase out at 150,000 for married couples, and it's fully phased out at 160. It's for a head of household, it starts at 112,500 and is phased out at 120. And the starting phase out is for single people, 75,000 and 80,000 for the full phase out. The National Tax Training Committee, NTTC 2021 Economic Impact Payment has a fillable worksheet that they've included in the volunteer portal. So that's also quite useful, actually. If people did not receive their economic impact payment, the worksheet has instructions on what number they need to call and what they need to do in order to initiate a trace on the funds to see where they went. So I did have one of these in the past last season, 2020, and somebody had to fill out the forms and basically get the ball rolling as far as initiating a trace. I don't know how that trace is going, but I imagine it's a pretty slow process. Our job is going to be to reconcile the what the taxpayer actually received for payments and compare that to what they should have received based on the information for 2021. So the thing that's going to help us the most to get the reconciliation done is that the taxpayer is going to provide us with IRS Form 1444C, which they should have received within 2 or 3 weeks from the time that they received the funds, either through direct deposit or the check mailed to their home. So they would have gotten that sometime around the time that they received the payment. The other thing that's going to help us is that there's an IRS letter 6475 that will be mailed to them in January of 2022 that will essentially contain the same information. Now, I suspect that the letter 6475 will be the most recent thing that they received. And if we did not receive, if they did not bring us the 1444C, they most likely will bring us the 6475. But in some cases, they may not actually bring us either one of them, and they can go to irs.gov and click on the button Get My Payment, which will provide them the information as to how much the payment was that they received, when it was deposited into their bank account, or when it was sent out as a check. And if it doesn't contain either one of those two pieces of information, it'll certainly give them information as to when they should expect to receive their payment. So that's about it for that. Here we have the IRS definition of a taxpayer and also the definition of a dependent with respect to the recovery rebate credit. So these definitions play an important role in determining who gets what. So a dependent is not a dependent if the person that could claim that dependent is not a taxpayer. Individuals that receive EIP3 using the non-filer tool, which is a tool found on irs.gov. It's just a button you can click on, and you can request your economic impact payment as a non-filer. They're not treated as taxpayers. So if they take that route in order to get their EIP, they are from that point on for that tax year not considered taxpayers. Individuals that filed the return solely to claim the RRC are also not treated as taxpayers. So if they filed the tax return just for the sole purpose of getting their recovery rebate credit, and there's nothing else going on with their tax return, they are not considered taxpayers for the purposes of RRC. Individuals that could have otherwise been their dependent are in this case not their dependents for RRC purposes and can claim their own benefits. So this is important to the dependents because the dependents can now claim their own benefits if the person that could have claimed them as a dependent only filed the tax return just to get the RRC, or they used the non-filer tool on irs.gov. So the bottom line here is that when filing for RRC only, so if we're doing this for any of our taxpayers, if we're filing just to get the recovery rebate credit, if they did normally qualify to have dependents on their tax return, it is imperative that we do not include those dependents in this particular case. For 2021, TaxSlayer has made a change in their menu structure. Last year, when we did a tax return for one of our taxpayers, we would ask them how much they received for their economic impact payment. And at that point, we would actually enter this information under the basic information section of the tax return. TaxSlayer has moved that feature now into the COVID-19 relief section, a brand new section that they've added on the left-hand side of the screen. You can see that I've circled it. And the submenus that you'll find under COVID-19 relief are Advanced Child Tax Credit, the Recovery Rebate Credit, and Form 7202 for the credits for sick and family leave for certain self-employed individuals. So those three entries can be found here, can be quickly accessed by going to this COVID-19 relief section. But they can also still be accessed the way we've always done in the past, which is to go to the credit menu under deductions, and you will find advanced child tax credit there, along with recovery rebate credit in Form 7202. So you can go to either place, but I think this is probably the quickest. For tax year 2021, there are some pretty substantial changes to the child tax credit. So the next several slides are going to address those changes. Refundable child tax credit, RCTC, for 2021, good only for 2021. So the credit for the child tax credit has increased from 2,000 to 3,000. 3,000 for children that are ages 6 to 17, and then 3,600 if the child is under 6. Previously, the credit was $2,000, which was a combination of the child tax credit and the additional child tax credit. The additional child tax credit could be no more, in prior years, could be no more than $1,400, but now the entire child tax credit is refundable. It was only the $1,400 that was refundable last year. So the qualifying children now are under age 18, whereas previously they were under age 17. So that's changed. But now the big qualification here is that if the principal place of abode is in the United States or a resident of Puerto Rico for more than half the year. So that wasn't a qualifying item last time around, but it is now. So if anybody did not qualify because their place of abode for at least half the year was in the US or Puerto Rico, then they would have to revert back to the rules for last year. Principal place of abode. We use the same definition for principal place of abode that we've used in the past for head of household filing status, and that we've also used for dependency purposes. So nothing's changed with that definition. It ignores temporary absences, so that if somebody's away to college or away from their home for temporary absences, they're still qualified for principal place of abode, provided they live in that same place for at least half the year. And there is now a checkbox on Form 8812 for principal place of abode, and that essentially triggers the refundable child tax credit. So once that box is checked, the taxpayer would qualify for the refundable child tax credit. One note here, the Form 8812 is now a 3-page form, whereas in past years it's been a 1-page form. So there's a lot more going on with that form for 2021 than there was in the past, because we have a lot of different iterations of this child tax credit. So it is fully implemented in TaxSlayer, however, so as of January 1st, it's fully implemented and the checkbox is available. And so as far as refundable child tax credit, they can all be tested in TaxSlayer. That's it for now. Here is the TaxSlayer screen for the advanced child tax credit. And this is the all-important screen that has the question with regard to the principal place of abode being in the United States for more than half of 2021. So this is the place where you would answer yes to this question if the person did have the place of abode greater than 6 months. And keep in mind that the answer to this question is going to affect both the advanced child tax credit and also the child and dependent care credit as well. So there's only one question being asked in one place, and it affects both credits. So you'll need to know how to access this. You need to go to the credits menu and select advanced child tax credit, and then answer this question here. Now you also have a place to put the aggregate amount of advanced child tax credit payments you and your spouse received for 2021. So if the taxpayer and their spouse did receive payments starting in July of 2021, then you would put the aggregate amount down in this box. However, if they did not receive any aggregate amounts, you would leave this box blank. I tried putting a 0 in this box and it gave me an error message. So do not put 0, just simply leave it blank. And number of qualifying children, you would also, if there were no aggregate payments, you would also leave this as it is with 0. And not put anything in here. So if you're only answering this question, this top question, for the benefit of the child and dependent care credit, then you just simply answer yes to the question and don't put anything else in any of the other boxes. The refundable child tax credit, the fully refundable child tax credit for 2021 has a little bit different phase out approach than other tax credits. So here we have, it's kind of a two-phase approach. The first phase being the increased amount is phased out using this chart that we see here on the slide. And then there's another step that goes beyond this that I'll talk about later. But so for instance, the child tax credit having increased for children 6 to 17, ages 6 to 17 years, increased by $1,000 for 2021 over what it was for 2020. So that phase out amount, that additional $1,000 is phased out based on the chart that you see. And in the case of children under 6, there's a $1,600 increase from 2020 to 2021. And that $1,600 would be phased out again using the chart below. So they start at the modified adjusted gross income of 150,000 for married filing jointly, had 112,500 for head of household, and 75,000 for others. So those are the starting points that these additional funds will phase out. And then we move on to the next phase. Now we get into the second phase of the phase out, and that's the remaining child tax credit. Once we've gotten past phase one, then we start looking at the high income phase out range. And the phase out begins for married filing joint couples, $400,000. And for all others, that phase out starts at 200,000. And then it works up from there from 400,000 to, I'm not sure what the total, what the back end of that phase out is, but somewhere between 400 and some other number, there will be totally phased out. So you can see that the income has to be pretty significant before the child tax credit is completely phased out. Taxpayers that are not eligible for the refundable child tax credit can still claim the non-refundable child tax credit along with the refundable additional child tax credit as in previous years, and that maxes out at $2,000. So the combination of the non-refundable component and the refundable component together combined max out at $2,000. So the kind of taxpayer that would make use of the old child tax credit is somebody who did not have a principal place of abode in the United States or in Puerto Rico. The additional child tax credit is also subject to the customary ACTC rules, such as earned income requirement and the maximum of $1,400 per child. So probably one of the biggest changes in the child tax credit for 2021 is this feature of advanced payments. So starting in July of 2021, parents with young children began receiving monthly payments, which were these advance payments against the credit. What it boiled down to was 1/12 of the annual amount was doled out on a monthly basis. And again, it started in July. And based on the payments that were sent out were based on either the 2019 or the 2020 tax return. And if the 2020 tax return was not processed, then they would go back to 2019 to see what a parent qualified for. There were no payments made for any children that passed away before January 1st, 2021. So children that were on a prior year tax return, but were not on the 2021 tax return did not qualify for getting the payment. Taxpayers can opt out of the advance on irs.gov, and they can also make changes on irs.gov with respect to their bank account information and their credit eligibility. So it behooves parents with young children to actually create an account on irs.gov where you can control all of these things. So that's the advice we should be giving. So in the final analysis, we as tax preparers and counselors are in fact reconciling these advance payments against the actual credit that the taxpayer qualified for. So what the taxpayer qualified for is determined for tax year 2021, even though it was originally started being paid out based on the 2019 or 2020 tax return. So it's really the 2021 tax year that's the determining factor as far as what they actually qualified for. So any excess advance payments are treated as an additional tax on the 2021 tax return. And it may be this tax may be reduced based on the modified adjusted gross income and the number of qualifying children. So if the modified adjusted gross income is low enough, these people may not have to repay or get this additional tax on their tax return at all. So again, for low income people, they would be excused from this and would not be assessed that additional tax. So for 2021, there is a letter that the taxpayer will receive in January of 2022, letter 6419, and that will provide information for the tax preparer, such as the amount of the advanced child tax credit that was paid out and the number of qualifying children that were taken into account when that check was cut or when that payment was made. There is a separate letter to each spouse if you had a married couple filing jointly, because the child tax credit is based on probably 2019 tax year, possibly 2020. And so if anything had changed at that point, it just made sense that each spouse would get a copy of the letter because who knows what could happen between a married couple over a 3-year period. So, and as I mentioned earlier, the Form 8812 is now 3 pages long and has a lot more information on it. So that's all implemented in TaxSlayer. The next several slides cover the earned income credit changes for 2021, which are quite significant, and probably this is the one feature in 2021 that is probably makes the biggest difference to the Tax-Aide organization. These are rather large changes that are going to impact us. So here we go. The changes on this slide are permanent changes for the earned income credit. So first of all, a taxpayer, unlike in previous years, a taxpayer now can still claim the earned income credit even when they have a qualifying child that does not have a Social Security number. The taxpayer can simply apply for the earned income credit without any children, and this year the earned income credit is as much as $1,500 for somebody who does not have children and is above the age of 18. So it's worthwhile for somebody to apply for the earned income credit in a situation like that. Certain separated spouses are now eligible for the credit. So there are a couple of exceptions that did not exist previously. If you look at footnote number 4 on page I2 of Pub 4012, the Volunteer Resource Guide, you will see the various exceptions for separated adults who separated spouses so that they're now eligible for the credit in certain situations. And now the disqualifying investment income has gone up from 3,650 in 2020 to 10,000 in 2021. So that's pretty significant. So a taxpayer can have some pretty significant investments and still not be disqualified from getting the earned income credit. This feature of the earned income credit is specific to 2021 only. It gives the taxpayer the ability to use the 2019 earned income rather than the 2021 earned income, but only if the 2019 earned income is higher. So, and that it even pertains to a situation where the 2021 earned income may be actually zero. They can go back to 2019 and use that earned income instead. We, of course, will need to see the 2019 tax return along with the 2020 when the taxpayer comes to our site. So they need to be they need to bring with them their 2019 tax return and the 2020. So hopefully the people that are making appointments for your site will be aware of this and will give them a little a little heads up as to what they need to bring. Now also there is an instruction sheet in the volunteer portal library that's titled Using 2019 Earned Income for 2021 Tax Returns. So it gives you instructions on how to calculate or how to find the earned income for 2019 that you would then enter into a box on the 2021 tax layer screen. You can find a link to this document by going to the NTTC Modified Publication 4012 Volunteer Resource Guide. And if you look on page I-1, you will see in blue a link and it says Using 2019 Earned Income for 2021 Tax Returns. Click on that and you will get the sheet that will give you specific instructions on how to do it. This slide here refers to many of the taxpayers that we see at our Tax-Aide sites. So you may recall that I said earlier that this earned income credit change for 2021 is going to make a big difference at Tax-Aide sites around the country. So to start with, we're talking about taxpayers with no qualifying children and some earned income. They have to have some earned income in order to qualify for earned income credit. Now, the starting age, the minimum age to qualify for the earned income credit is one of three things. Generally, it's age 19, but we have a couple of exceptions here. It's the starting age is age 24 for specified students as defined by the American Opportunity Credit. And also there's an exception bringing it down to age 18 for qualified former foster youth or homeless youth. So generally, the starting age has got to be either 18, 19, or 24, depending on what category you fall into. And also, you can note here that those born January 1st are treated as being born the previous year. Now, that may sound like something unusual, but really it isn't, because when you stop and think about it, any tax return that you do, a person's age for any given tax year is actually their age on January 1st of the following year. So unlike the marriage situation where a person is considered married if they're married on December 31st of the tax year, age is a different animal. Age is looked at on January 1st of the following year. So for 2021, anybody that is born January 1st of 2022 is actually that same age for 2021 as far as the tax law is concerned. So moving right along, the maximum age used to be 65, but that ceiling is now gone. So there is no maximum age. So again, senior citizens that come to us that are over 65 are now going to qualify. As long as they have some earned income, they're going to qualify for the earned income tax credit. The phase outs have been changed. The phase outs are more gradual than they were before, and the phase out amounts have increased for 2021. So in the next slide, I'm going to show you a little graph. Here is the graph of earned income credit for 2021. So you can see that the solid lines are for single or head of household, and the dotted lines are for married filing jointly. So you can see that the orange line, for instance, for 3 or more children. So if you have somebody with 3 or more children, they have a pretty significant earned income credit, somewhere around 6,800 or so, being their earned income tax credit. But you can see how it phases out on the back side of the graph. So it totally phases out at a little over $50,000. And so if their income being across the bottom line, their AGI, earned income, and on the left-hand side is the actual credit amount that they're going to receive. So you can see that the red is for no children, the green is for 1 child, and the blue is for 2 children, orange 3 or more children. So you can see exactly how this works. And my experience has been over the years that people that qualify for earned income credit actually know this graph very, very well. And actually, it's kind of amazing how people somehow just miraculously end up at the very peak of um, one of these graphs, whether they have one, two, or three children. They seem to know where that peak is, and they seem to earn just the right amount of money to keep them at the top of that graph. And I'm sure it's no coincidence. It's just because they know the system. So that's about it for the graph and earned income credit. Child and dependent care credit for 2021. For 2021 only, the child and dependent care credit has gone through a few changes. It used to be $3,000 worth of child care expenses for one child and 6,000 or more, 6,000 for one or more for more than one child. Now it has gone up to $8,000 for one child and $16,000 for more than one child. The maximum credit also has increased to 50% of expenses where it was 35% in the past. And then it begins to phase down at AGI of 125,000, but that was 15,000, so that's gone up a lot. And it phases down initially, and then it ultimately will phase out when you get above $400,000 worth of adjusted gross income. So it's available to a lot of parents who need it and can certainly use it. Another significant change is that the child and dependent care credit is now refundable, whereas in the past it was non-refundable. So as long as the taxpayer has their principal place of abode in the U.S. for more than half of 2021, it can be refundable. And if married filing jointly, only one spouse needs to qualify. So the married couple can use this feature, whether or not they both qualify. They only need one to qualify. Remains non-refundable if the abode is outside of the United States. So it reverts back to the old rules if that's the case. And special rules exist for residents of U.S. possessions such as Puerto Rico. As we saw in a previous slide, there is one checkbox for two credits, the advanced child tax credit and the child and dependent care credit. Both use the same checkbox to determine whether the taxpayer qualifies for the credits or not. And so I showed you a slide earlier on where that checkbox is. If the box is not checked in this particular case for the child and dependent care credit, then TSO is going to revert back to the 2020 rules, and the taxpayer will not get the full credit and will also not have all of it be refundable. Only a portion of it will be refundable back using the 2020 rules. If the box is not checked, when there's a qualifying child associated with the account, then TSO e-file section will warn the preparer. So if there's a child on the tax return, when the tax preparer gets to the e-file section, there will be a warning indicating that there may be missing information under that category, and it gives a button. I'll actually show you the screen in just a couple of slides. So the Form 2441 finally is now implemented in TSO as of January 2nd, and it is now okay to proceed with the IRS Advanced Certification. So if you feel that you have enough information with this training that you feel confident to go ahead with the Advanced Certification, there's nothing in TSO that's going to negatively affect that test. So you can go ahead and take that if you want to, or you can do additional research if you need to. Here again is the tax layer screen with the question about the principal place of abode. Just wanted to show it to you again under this category so that you realize that both of these credits, advanced child tax credit and the child and dependent care credit, are both affected by answering yes or no to this question about principal place of abode. And again, I want to mention that If there were no aggregate payments made on the advanced child tax credit, then just simply leave those following two boxes blank, and that should turn on your fully refundable child independent care credit. Here is the warning screen in TaxSlayer Online. Once you get to the e-file section of your tax return, if you have not checked that box yes for the principal place of abode, you're going to get a warning in the e-file section, and this is what the warning looks like. There may be an error on your federal return. Please take a moment to review the following before you continue. And then you have a button that you can click on that says fix this, and that'll immediately bring you to the spot where the question needs to be answered. For 2021 only, there's a feature called Child Independent Care Assistance. This is the assistance where a taxpayer's employer pays their dependent care benefits, and it appears on their W-2. So there's a tax exclusion which was $5,000, now as much as $10,500 for a married couple, and also can be split if married filing separately, $5,250 each taxpayer. So it should be in box 10 on the W-2 for 2021. So that's tax exempt. Now let's talk about sick and family leave credits for self-employed. So this started last year and continues into 2021. So there are two rounds of this sick and family leave credit. The first round from April 1st, 2020 to March 31st, 2021. And now this second round has been created from April 1st, 2021 to September 30th. And there's a lot of talk that this may be extended even further beyond September 30th, 2021. So family leave, the second round of family leave has increased to 60 days, which was 50 in the past, and it went up from $10,000 to as much as $12,000 worth of credit that a self-employed person can receive if they meet the qualifications. And we'll get into that a little bit later. The sick leave second round remains at 10 days as it was before for a maximum of $5,110. And that again is a sick leave credit for especially people that are affected by COVID directly. Can elect to use the 2020 net earnings for self-employment. So if 2020 net earnings give them a better result, they can use 2020 as opposed to 2021 net earnings. So the second round of sick leave, part 1 and part 2 of Form 7202 has been enhanced to cover more reasons. So you can look this up in Pub 4012 in tab H, page 9, 10, and 11. So those 3 pages talk about the sick and family leave and what the changes are for 2021. So feel free to look that up. NTTC 2021 Self-Employed COVID Worksheet has been developed by the National Tax Training Committee, and they did a very nice job of really consolidating all of this into a very easily understood worksheet that will be very helpful to us. It was helpful last year, it'll be helpful again this year. So with this sick and family leave credit for the self-employed, we must follow IRS guidelines, and you need to look at page 2 of the self-employed COVID worksheet that appears in the AARP volunteer portal. That will help you. 2021 Form 7202 has 4 parts that cover both rounds for both credits. So 7202 is the form that we're going to be using to qualify these people for their credit. Cannot claim the same days for both credits, so you can't double dip. The credit limit is reduced by employer paid leave wages. So if the employer is paying on their W-2, it shows that there is payment made to cover those wages. They cannot double dip here either. Special rules apply to U.S. possessions, so they're treated differently. Let's talk about the premium tax credits for 2021 and 2022. These are the tax credits that were given for people that qualified when they were buying health insurance from the marketplace. So this was all developed under the Affordable Care Act in the Obama administration a few years ago. And so there have been some changes for 21 and 2022. One of those changes is this number called the applicable figure. So without getting into a lot of detail about what this is, the calculation as far as calculating the premium tax credit used this applicable figure number. And this number for 2021 and 2022 has been reduced. And by reducing that number, it actually made more people available for more premium tax credit. So that's the good news. The good news is more people get it, more people get a larger tax credit than they got in the past. Taxpayers with modified adjusted gross income greater than 400% of federal poverty line in the past were excluded from getting premium tax credit. Now in 21-22, they are now considered applicable taxpayers, and they now do qualify for the premium tax credit. Now, if they somehow get excess advanced premium tax credit, if they end up getting more in advance than what they qualify for in 2021 or 2022, they do have the requirement to repay that tax credit as part of their tax return process for 2021 and 2022. Now, in 2020, however, the Congress did vote to stop the excess from having to be paid back. So in 2020, Congress decided that taxpayers did not have to repay this excess. However, for 2021, 2022, they do have to repay it. At this point, Congress may make some other decision after this recording, but for now, they do have to pay it back. Now, here's a feature of premium tax credit for 2021 only. Taxpayer who are receiving or are approved to receive unemployment for any week beginning in 2021 are treated as applicable taxpayers and can qualify now for premium tax credit. They must still file a married filing jointly return if married, though. So they can't file married filing separately. It has to be jointly. Household income in excess of 133% of federal poverty line is overlooked for purposes of computing PTC. So that's a new feature as well. So there have been changes made to premium tax credits.